Now let us look at control
Control to
to
no control.
no control. So this control to no control is akin to saying now the company want to become associates. So control to no control is like the company is what trying to what they don't want to what be the parent anymore. They may become what do you call it associate. So here, if you have parent, maybe the parent has what 60% stake, and the subsidiary is 40%. Now the company want to sell off. Maybe the company dispose 20% off. So you realize that the parent will lose control, which is 60% minus what 20%. That brings it to what 40%. You understand? So this is what we call control to no control.
40.
So
Yes, sir.
that is it about what control to no control. So how do we go about control to no control? How do we analyze what control to no control? Right? So control to no control is like what you are disposing of what majority share of what of the company. Now, how do we account for it? We have two methods or forms of what accounting for control to no control. Formats like this. So format one, you will have the proceeds. You'll have the proceeds here. Then the investment that you are currently holding, how much is left after you sold the company. You will come and add it here. When you are done, then you will come and look at what the value actually of what of the subsidiary that you are holding. What is the value of the subsidiary? So you say that what the carrying amount of subsidiary is how much? Carrying amount of subsidiary is how much? So you have what? The net asset of what? Net asset of what? Of disposal is how much? Then you add what we call what? Unimpaired goodwill or goodwill. Add goodwill. If goodwill, part of it is impaired, remove it first. Then you come and do what we call you less NCI from this. This is the format. So here, so you have the proceeds here, the investments here. So whatever you get, you less this one from that. So whatever you get, then you come and less it here. Then you get gain or loss on what? On disposal. That's all. So this is the format. So this is the format. So the formats are two, but I will stick to this one alone. Okay,
Thank you.
so let us look at example of what? Control to no control, right? Okay.
Yes. Yes, sir.
All right, so let's look at first question. Sox owned 90% of Mox before it decided to sell a 50% stake of its investment on what? On 31st December 2015 for 120 million. The non-controlling interest at that date was what? 53 million. And the fair value of the remaining 40% is what? 96 million. The goodwill on acquisition of original 90% holding was 38 million. And the net asset at the date of disposal were 201 million. Calculate the group profit on disposal that will appear in the what? In the group financial statement of subgroup for the year. So here, what can you say here? The company, the Sox is the parent that owes 90% of Mox, and they decided to sell 50% of Mox. And how much would that be left?
40.
Now, this 40, the investment portfolio, where can you classify it?
This is an associate.
Absolutely. So when you remove 50% from 90, you become associate automatically. So how much did they sell it?
They sold it at 120 million.
You understand? It's simple. They sold it. So this is the proceeds. So when they sold it, so the non-controlling interest at the date was 53 million. The non-controlling interest at the date was 53 million, and fair value of the remaining 40% is what? It's 96 million. So what does this tell you? It tells you that the non-controlling interest at that date At that date was 53 million. Now this 53 million has gained in what? In value.
Yes.
96 million at the instance of what? 40%. The 40%
Yes,
left now values at 96 million. And this non-controlling interest should tell you that the fair value or the NCI of this asset was what? Was 53 million. Now the 40% after sales has now gained value to what? To 96 million. Okay. They said the goodwill is what? The goodwill is 36 million.
38.
38 million. And the net assets at the date of what? Disposal were what? Were 200 and what? 1 million. So it's simple. Let's go in. Okay, so let's come here. Example. So disposal. How much percentage are they disposing?
50.
Is the handwriting okay?
Yes, sir.
Good. So watch here. Proceeds. How much did they sell?
They sold the thing at a price of 120.
Thank you very much. 120. So let's make it 120, right? Investment held. Watch here. Follow the format. What did they say? They said that when they sold the assets at the price of 120 million, the fair value of what is remaining, you understand, the remaining asset after disposing it, after you sold the 50% of it, the remaining. So here you can bring it here, investment held or remaining what?
That is
Okay, or remaining what?
Remaining NCI value
or remaining stake that you have.
Yes.
Now, when you look at this, they said they have 40% left in the company. Their percentage left in the company is how much? You understand? So the remaining investment, which is what? 40%. The fair value of it is how much? 96 million.
Yes.
You understand? So when you are done, you add it. That's all. What do you have?
216, sir.
216. You see, now when you are done, then you come here, then you come and do your carrying amount of subsidiary. You understand? So what is the carrying amount of your subsidiary? You understand? So here they want to compare how much the proceed and the cost, right? Okay. So here the net assets of the asset that you are disposing of. The net asset of the asset that you are disposing of. Read the question. You will see it there. They said that the net asset at the date of disposal were what? 200 and what? 1 million. You understand? So clearly this asset is what? Is increasing in value. You understand? Because look at it. When they sold the 50% off, the remaining 40% has value of what? 96 million. When you look at the total asset that you the total asset of that NCI, the total asset, meaning the original 90%, the fair value of that original 90% of what? Of a stock stake in Mox is 201. The fair value of that asset. So which is what? 200 and what? 1 million. And you add your what? Your goodwill. In the question, did they give you goodwill? Yes. They said that the goodwill is what? How much? 38.
Yes.
You add goodwill, then you less NCI fair value.
Yeah.
So the NCI fair value is how much? 53. You see, read the question. You realize that they said that the non-controlling interest at the date was what? 53 million. And the fair value of the remaining 40% is what? 96 million. And then the 50%, the 90% asset you acquired in what? In the mall. Or now the original value of what? Of that, the fair value of that asset. Do you remember? You remember what do you call it? Net asset of what? Of subsidiary. You remember it?
Yes, sir.
This is what they are talking about. So what do you have? Add this one, you subtract this.
You get 186.
186. Then you less this from that. What do you have?
30.
So this becomes gain on what? Disposal.
Disposal.
And this one, it will go to where? P&L account. Do you understand?
Yes, sir.
This will go to P&L. And let me look at, yeah, this one will go to P&L. Any questions so far?
No, sir.
Okay. So let's look at example number 2. So go to example number 2. They said that who acquired 60% of what? Equity interest of Kumasi Limited. A company also in 2016, right? Company also in Ghana on 30th September 2016. The purchase consideration was what? Was of 30 million cash.
35.
Kumasi
35 million.
35 million. Kumasi's identifiable net assets were fair valued at what? 43 million. And the non-controlling interest had a fair value of what? 14 million at that date. Do you understand? You understand what you call net asset fair value? And the non-controlling interest had fair value of 14 million at that date. It means NCI is fair value. That's the meaning. Okay.
Yeah.
On 1st April 2018, Ho disposed of 40% equity share in Kumasi for consideration of what? 25 million.
25.
Kumasi identifiable net assets were 45 million, and the value of the non-controlling interest was what? 17 million at that date of disposal. Clearly, the net assets of what? Of the company has what? Has increased. The remaining equity interest for the value was fair valued at 20 million. You understand? After the disposal, who exerts significant influence, any increase in net assets since acquisition has been reported in the profit and loss account, right? In Kumasi had not changed since. I think that is all about that, right? So the rest are just other. So goodwill had been tested for impairment and found that no impairment was required. No entry had been made in financial statement for Ho Limited. Okay, so all right. Okay, so I think that is all about this very question. They've given you all the ingredients that you needed in this very question to work it out. All right. So here first, since we know we know the processes, right, that we can use to determine goodwill of an asset. Let us first define, because when you look at the format, you can see, because they surely know that the moment parent acquires subsidiary, they will surely have what? Goodwill in the acquisition, right? Being in negative or positive. All right. Positive. So here, in this instance, they didn't give us what? Explicitly give us what? Goodwill. You understand? They didn't give us goodwill explicitly in the question. Can we find goodwill in this question? Yes. So watch here. First, find goodwill. How do we find goodwill? You will start with your purchase consideration. When you check the question, can't you see the purchase consideration to what? To be 35 million. Can't you see that?
Yes, sir.
Okay, so let's assume it's what? 35,000. Then from purchase consideration, what next?
Then we add fair value.
So here, all you have to do is that watch here. They've given it to you that identify net asset of fair value. You understand? They are telling you that the asset has been what? Has been fairly valued. Do you understand? So the identified net asset of fair value at what? 43 million. So this is what? Fair value at the beginning of asset, and then the non-controlling interest had the fair value of 14 million. It means you use fair value method to determine the goodwill of this particular company. You understand? So the identified net asset were fair value of 43. This is what? At acquisition net asset of subsidiary. Take note of that. Are you with me?
Okay. Yes, sir.
Good. Now, and they are telling you that the non-controlling interest is 14 million. So here, you will come here, then you say, since NCI is fair value, so you say you add what? NCI fair value, which is how much? 14 million. You make it 14,000. So when you add, what do you have? This plus that gives you what? 49,000.
49,000.
Right. So when you are done there, you say less what? Net asset at what? At acquisition. Are you with me? So the net asset, where do we get our net asset at acquisition? I've already told you here that the identifiable net assets were fair value at 43 million. This is what? At reporting what? Fair value.
43.
You understand? And 45 is what?
Yeah.
This where 43 is what? At acquisition fair value. So, and the date that they are reporting, if it is 45 million, that will be at what? At reporting fair value. So here, at acquisition, the fair value of what? Of the asset was what? 43. Then you less it. What do you have?
It
So
gets
gives you what?
6.
6,000. So this is your what? Your good one. Simple. This is your good one. Simple. So here you know our good one. Then we can now go on to do our what? Our disposal of what? Of the assets. It's simple. So how do we calculate the disposal of the assets? All you have to do is that disposal of what? Of Kumasi. What is the Kumasi that they are disposing? They are disposing how much? 40% out of how much? They are
40% out of 60.
60%. Clearly, they want to become associates. So here, how much is the proceeds? How much did they sell?
They sold it at 35 million, sir.
They sold it at what? 35 million. Are you sure?
25 million. 25 million.
You should differentiate between purchase consideration and disposal consideration. You should know that.
25 million.
25 million. All right. So the proceed is for 25 million. So let's make it 25,000. And they said how much is the remaining?
The remaining
investment
coming,
which is what? 20% left.
20%. I'm coming.
Percent left. Check. I've seen it already.
The remaining equity interest was fairly valued at 20 million.
All right. So it's 20,000, right?
Yes, sir.
Then you add it. What do you have? 45,000, right? So when you are done, what next? Then you will find the net asset of disposal.
You go to
here. I said first, look for what? What did I say you should look out for? The format is here. First, you should look for what? So you have it here. Check the format. Carrying amount of what? Subsidiary. Then you look for net asset of disposal. That's all. So
45.
So carrying amount of subsidiary. So now here you have what? Net asset of what? Net asset at disposal. So when you are disposing the asset, what is the value of what? So net assets at disposal. What is the what? The value of what? Of the net asset of what? Of the subsidiary when you are disposing it of how much?
45.
Thank you very much. It is there. You will see it there. Identify net asset were 45 million. You understand? So that's what? 45,000. And then the next one is what? You should find the what? You should find the goodwill, right? The goodwill is how much?
The goodwill, that is what we calculated.
6,000. Then you less what? NCI fair value. You understand? So the NCI fair value, watch it. It is in there. You realize that. And the
17.
value of non-controlling interest was 17 million at the date of disposal. So the NCI fair value has moved from where? It has moved from what? From 14,000 to what? To 17. Have you seen it?
Yeah.
Yes, the date of what? So that is then you will let that one, which is 17,000. So when you will let, what do you have?
34,000, sir.
Okay, so what do you have here? So this is what? Gain on disposal.
11,000, sir.
So this money will go to where? Profit and loss account.
Yes, sir.
Are you with me? Okay, so that is so.
Yes,
this one,
sir.
11,000 will go to what? P&L account. As what? Investment on what? Gain on what? Disposal. You understand? So when you go to also, because so now the parent is now subsidiary associate, right? So you realize that when they are what? When they are preparing their statement of financial position, this company, when they are preparing their statement of financial position, they will have what? Your statement of financial position, non-current asset, they will have what? Their PPE, and then other investors, then they will bring their associate. The associate is what 20%. And it is now what 20,000 or 20 million in their books. So that is
That's
it
it.
about this one. That's it about
Now
this
let's
one.
go.
Any question?
No, sir.